Okay, so welcome back to the CPA Firm Partners Conference. My name is Mark Belache. I'm president of TorontoJobs.ca. I want to thank you if you've just been joining from another session, coming in and meeting up with Tony, and looking forward to this presentation. Tony Salgado is president of AMS Wealth Inc, and he will be talking about why insurance and succession planning matters. Tony's a trained estate and tax planning accountant and life insurance advisor. Before founding AMS Wealth, Tony held various director positions within wealth advisory firms and began his career with PricewaterhouseCoopers, PwC, providing tax planning to high net worth individuals and business owners. Tony's has provided insightful information on matters regarding personal finance, tax, and estate planning to various media outlets such as the Financial Post, Globe and Mail, Advisor.ca, and has appeared as a guest on BNN Television and CBC Radio. Tony has tutored for the CPA Canada in-depth tax program and has been a facilitator for the CPA Ontario program. So feel free to post any questions that you might have on the right-hand side for any questions that you might have on Tony. And thanks for being on here, Tony, and I'll let you go. And go ahead. Thanks so much.
Thanks for having me. I have to make that intro shorter. Not sure how I'm going to do that, but it's a pleasure to be here. And I think what I'll do is I will start the slides from there, if I can do that there. Okay. So what we're going to be looking at today, we're going to be looking at family business planning. And I put some questions up on the polls. I think they're very interesting questions. And hopefully I get some feedback and some answers so I can talk to some of the answers I get. This session is going to be focused, it's going to be kind of a little bit of everything, where we're going to be looking at a little bit of tax, a little bit of insurance, and a little bit of estate planning, which is kind of like an all-encompassing view of how we should be advising clients when it comes to succession and estate planning. So I'm looking for your input. If you have any questions, feel free to put them onto the chat box. I normally do sessions, but not as interactive as this. So looking forward to getting responses into the chat box and the poll question. So a little bit about a family business. If you've never seen this model before, a privately held family-owned business is really centered on these three circles. And there's something called, like, what is this three-circle model? This model is kind of fundamental when you're talking to family-owned, privately held businesses to identify where it is you actually fit in the box, or in the circle. So when you speak to a family-owned business and the stakeholders that are involved in the family-owned business, you're going to be looking at where do you actually fit in this pie, and can you fit in 7 different locations? So can you be both an owner and a manager? Can you be just family? And there needs to be this fundamental understanding of you can be just family and you can be just owner, or you can be all of these things together. And not everyone is suited for every single role. So starting the conversation with a family-owned business in terms of where you fit into this chart will allow us as advisors to give the proper advice to a family-owned business. So who is the business going to go to, and how is basically what we're trying to address. There's all these different imaginations of how a family-owned business can go from first generation to second. And we're going to be talking about what is the success of that transition, what is or the lack of success of going from first to second generation, and how can we help. Oftentimes it's not just a technical session, but more also an operational or a softer approach of who's the right person to be the next leader of this family enterprise. And that is both a technical and a soft conversation to make sure that the next generation is capable of leading the family business going forward. And maybe it's not. And if it's not, then who are we working with on a divestiture or a sale of the family-owned business? So kind of how do we help a family-owned business get to where they need to get to, and how can we give them the advice that they need to get there? So the family business, every family business is very different. No one family business is the exact same as the next. And what are some logical transitions of a family-owned business? So we can go second generation. So are all the children involved in the family-owned business, or is there one children that is involved? What about employees? Are employees the right step or the next logical phase of development for the private business? Or do we need to do an outright sale? Oftentimes there's this complication of what happens to this very valuable asset to move from one stage to the next. And if the employee group is the right logical move to buy out or to move the business forward, how does that happen tax efficiently? Oftentimes the number one thing you hear in feedbacks is, well, the employee group doesn't have the financing, right? So how are my VPs going to buy me out, the original founder, if they can't afford it? Very simple. They're the logical next step. So how does that work from a financing perspective? Where is there an insurable interest? So if we're saying that the employee group is going to pay out the founder over the next 5 years, is there a life insurance problem or an opportunity to solve? So not only are we looking at tax efficiencies, whether it's the next generation and we're going to be looking at an estate freeze, whether it's selling to an employee group, if you're doing that, are you taking a vendor take back? So are you allowing your employees to pay you over time? Or are we going to be looking for an outright sale? So these are the things that we look for when we look at transition or succession planning to go from one generation to the next. And I put up a poll question and I hope I got some answers. And so the question is, what percentage of family-owned businesses actually fail to go from the first to the second generation? So I'm looking forward to getting some responses. And if you've voted that 70% fail from first to second generation, that's the correct response. So on average, we're looking at a 70% failure rate of first generation to second. By the time we get to a third generation, there's a 90% failure rate when we look at the succession of a family-owned business. And there's a bunch of really good TV shows now on succession planning. You can find that on HBO. Why is the failure rate so high? Not only is it a technical problem where people are not addressing the tax on death or estate complications created by leaving shares in your will, but it's also an operational problem. Have we identified the right leader to take the family-owned business from step A to step B? So these are both operational and technical issues, and surrounding the family business with the advisory team is kind of step one. And understanding where the accountant fits in, where the will planner fits in, where does the insurance planner fit in? And all of these people have to support the family-owned business for that success to lead on. A family-owned business or a business owner is probably going to have its most significant asset in that corporation or in that business. So how do you really take care of that asset? You can't talk about family transition planning without talking about tax. So how does tax impact the business owner and the succession planning for the business owner? So the next poll question you're going to be seeing up there is, what is the potential tax on death for a business owner in Ontario or in Canada? So specifically in Ontario, let's stick in Ontario, a business owner, someone that has value inside privately held companies, can have a potential tax liability of 70% upon death. So if you're sitting there looking at this saying 70%, is that possible? Yes, it is possible. Why is that? Well, here's the steps of the 70%. You have a deemed disposition inside your terminal T1. So you have a deemed disposition of the value of the shares you own. And so we're looking at maybe 25%. Let's call it capital gains rates upon death. Then you have the liquidation of the actual asset inside the corporation. So inside the corporation, you're probably going to have to sell something, whether it's real estate, inventory, capital property, and that's going to trigger a second layer of tax. And then you have the third layer of tax, which is distributing the money outside of the corporation after the person has passed away. So I always tell everyone, people die, but corporations don't. A corporation does not die. a person, now this is kind of very morbid, but I mean, I do work and breathe this stuff. So it's all death, taxes, and insurance. So I'm a hoot to take out onto a dinner date. You have these 3 layers of taxes, which get to this 70% tax that you could potentially face owning significant assets within your corporations. So you have layer number 1, deemed disposition upon death. Layer number 2, the corporation actually has to sell stuff. And layer number 3, the corporation actually has to pay the stuff out to your beneficiaries. All that together, you're looking at a 70% tax upon death. So what are some tax technical things that you need to know? Thing number 1, I put up a poll question on who has the highest marginal tax rates in the world. And I put up 4 options. And if you have answered Denmark, you're right. So Denmark has the highest, the last time I checked, marginal tax rates in the world. So we're looking at high 50s, 58, 59%, highest marginal tax rate in any of the countries that I track. And that is a significant tax bill. Where is Ontario's? Ontario's is at 53.5. So I said Ontario and not Canada because the rates will vary from province to province. So in Ontario, the highest marginal rate is 53.5. I've told you that in Denmark, we're looking at 58 to 59. So once you start eclipsing the 50% tax rate, you're starting to motivate people to do significant tax planning. So let's talk about tax planning. What are important things that we need to know of? Lifetime capital gains exemption. So if you run an active business, do you qualify for the exemption? So do you still have the exemption room available? And do the shares actually qualify? So do you run an active business? And there's a whole set of rules that we do not have time to go through today. Farming and fishing property. We have $1 million exemption if you run a family farm or a family fishing property. So do you qualify, and are you making use of these tax provisions that are available to lessen the burden of transferring family-owned businesses, private businesses from one generation to the next? You don't automatically qualify for these exemptions, so make sure you qualify before thinking that you're going to be using these exemptions. So what are the areas of tax that I really try to address with insurance? So life insurance can be such a valuable asset, and I really try to trigger 5 things with this thing. Life insurance is used to pay for tax upon death, to buy out inactive kids in the family business or redeem shares, to build a retirement asset. And so if you've never heard of this, you're going to probably think to yourself, how is that possible? So life insurance can actually be used to build a nest egg for you to actually utilize in retirement. Avoid the small business deduction grind. So if you are speaking to your accountants and you're building passive assets inside your corporations, are your accountants talking to you about the 50% tax on passive income and the inability to use the small business rate on the first 500,000 of active business income if you're building up too much of a passive portfolio? And besides, really short, and making it a short and sweet, life insurance allows you to build tax-deferred investment growth. It gets paid out tax-free, and 90 to 99% of it will come out tax-free out of a corporation. It's such a favorable tax tool, and that's why I really believe in making it one part of the succession and estate plan for a lot of private-owned family businesses. So what does the process look like? You need to start with understanding the family. So who's the main principal business founder? What are their relationships? Who are the kids involved? And who do they want to bequest? So when you look at, how many relationships are there? Who's the son or daughter of which relationship? This is actually an active case I have on the go right now. So I have 3 adult kids, but only one of them is actually working in the family business. And how do we leave a fair inheritance or an estate to the other 2 kids? And notice how I said fair and not equal. So fair is not always equal. Equal is not always fair. And these are kind of tough conversations that need to happen. So we look at, where is the wealth of the family? And how do we transition or move assets or leave behind assets to our intended beneficiaries in the most fair and tax efficient way? So we need to start with what does the family picture look like? and where are assets going to go. And you notice how I put up an asterisk there. I put a cancer survivor asterisk. For my business, that's super important. So I need to understand, besides relationships, kids, ages, dates of birth, I also need to understand, are there significant health risks associated with the family? What are you seeing up there now? Now you're seeing, how does that family fit in with their organizational structure? So the accountant has done a great job to help this family freeze the value of their operating company at $2 million, and you'll see that up there. And the growth from that 2 million has now been shifted through a family trust. So this is a typical corporate structure that I would be looking at to do my work. And so you may be thinking to yourself, well, what kind of work do you do if all of it's already done? And so this is a lot of the problems that we have in financial literacy when it comes to business owners, that doing an estate freeze equals doing an estate plan. And that couldn't be further from the truth. So doing an estate freeze or a tax transaction is a good thing, but it's kind of like giving you supercharged kind of like tires, but I don't give you a Ferrari. So what are you really going to do with the tires if I don't give you a Ferrari? You can't really do much. So this is kind of an all-encompassing exercise when we look at this organizational structure and we say, okay, we've frozen the value from the original founder, and you'll see those dotted lines that go into the opco of 2 million. Those dotted lines represent a frozen value. So what that means is every value or every dollar that the business has appreciated after the 2 million is now shifted. And so why do we do that? We do that to minimize the tax for the original founder upon death. So this transaction is its primary purpose is to minimize or stop the tax bill upon death from growing. So what is that telling the original founder? That's telling the original founder that, hey, Mr. or Mrs. Business Owner, you already have a significant tax problem. So I'm going to help you make that problem stop from growing any further. But how do you address the problem that you currently or you exist today? And how do you use insurance to actually help the problem that you have today? So kind of really, really key points. Most of my clients, if not all of my clients, will have a discussion around primary, secondary wills. So in Ontario, as a business owner, do you have both a personal and a corporate will? And have you spoken to an estates lawyer to help you set those up? We look at what is fair and what is equal, because fair and equal are not always the same thing. And then down below, I put in like 3 essential items. So as a growing family-owned business, have you done an estate freeze? Yes or no, and why? Have you looked at your life insurance? Yes or no, and what are we going to use insurance for? And have you looked at your wills? So again, plural in Ontario for business owners. We're looking at personal, corporate wills, sometimes primary, secondary. And if you have property outside of Canada, that's a whole other conversation. Do we need a specific will to govern the property outside of Canada? So most of my clients, business owners, will have primary, secondary wills. Don't forget the importance of powers of attorney. So powers of attorney for property, powers of attorney for health, and those have a significant impact on business owners, because can you imagine if your power of attorney for your family-owned business is your 20-year-old niece that has never taken a math course, and you know, it could be very, very complicated, because if your 20-year-old niece is your power of attorney, how is she going to be signing authority on your business? So these are kind of all of the things that go into succession planning for family-owned businesses. And all of these things have a place to make sure that the business owner is advised in an effective way. With the remainder time I have, I'm trying to fit in as much content as possible within the 30 minutes. I really want to get through these 3 live cases. I always found that case studies are the best way to learn. And so I think I have 7-8 minutes. We're going to spend 2 to 3 minutes on each case. We're going to look at a wine and cheese family, which is my favorite story, and I'm going to start there. We're going to look at a professional and his spouse and their kids, and we're going to look at a real estate developer in Ontario. So 3 real life cases, and I'll walk you through over the few minutes I have over how we could help. I got introduced to this widow. She was 85 years old. She was 85 years old. She had 4 kids, and her accountant recommended an estate freeze 10 years ago. and the estate freeze was done at $5 million. So an estate freeze is a good tax transaction, and that's what it is. It's not a comprehensive estate plan. The estate freeze allowed this business, this family-owned business, to not have an even bigger tax problem upon death. So let me get right to it. The business owner who passed away left frozen value $5 million preferred shares to his spouse. His spouse is now widowed. So upon the first death, there's no tax. So most of the people on this call will know that. Between spouses, there's not going to be a tax bill to pay. So the widow received a piece of paper that said it's worth $5 million. Great. She didn't have to pay any tax. She wasn't concerned. Then there was no discussion of what is the tax bill on that $5 million. So is the tax bill on that $5 million $1.2 million? Best case scenario, let's assume the tax on that when she passes away is $1.2 million. When I met this 85-year-old widow, she had, other than these preferred shares, the only significant asset she had left was $2 million inside a registered account. So she had a $2 million, call it RIF, okay? And upon death, that $2 million was also going to be taxable at 53.5%. When I first started the conversation with her, in her mind and in her heart, she believed that she was going to be leaving $500,000 to four grandkids, because she thought, I have $2 million inside my registered account. When I pass away, I'm going to leave $500,000 to each of my 4 grandkids. What she didn't know was that the preferred shares that had rolled over to her, so rolled means there was no tax, incur a $1.2 million tax bill when she passes away. And the distribution from the registered account was going to be less than $1 million. So instead of leaving $500,000 to each grandkid, she was actually leaving her one son that was running the family-owned business a significant cash liquidity problem, because the cash from the registered account wasn't even enough to cover the bill of taxes on this file. So they did an estate freeze, and then they never signed a shareholders agreement. They had 4 adult kids all receive shares of the family business. One of the 4 adult kids actually worked there, and he worked hard. He was there 6:30 a.m. and he was there 6:30 p.m. The other 3 kids never showed up. And yet the family business was shared equally between the 4 kids. And when you were on earlier and you saw that we have a 70% failure rate, this really speaks to why the transition never worked successfully 70% of the time. So next file, we have a professional. We have a professional married, in husband and wife, mid-50s. They have a net worth of about $20 million. So they've come to me and they've determined that upon death, they have a $4 million tax bill upon death. Again, husband and wife, so the tax bill is not actually owing when one passes away, but owing when both pass away. So he came to me and he said, I have all of these investments. So this gentleman has invested in cannabis, in storage facilities. He had all of these other pieces of investments outside his professional corp. And he understood the value of tax efficiencies and insurance. So he said, my family is going to have a $4 million tax problem when I pass away. My kids are not involved in the family business. Once we pass away, wife and I, we want a tax efficient distribution to our kids. So let's look at tax efficiencies. So in his case, we looked at contributing $1 million over a period of 6 years. So you'll see right at the bottom there, some deposits $960. And that led to a $4 million payout upon life expectancy. So you'll see 3 little letters that really, really mean a lot in the business world, business owner world, which is CDA. So the capital dividend account, right on it's my right, so it could be your right or your left. But on my right-hand side, you see the little box, 4.1 million. That is tax-free money that's going to come out to the kids. And you see the box on this side, 960,000. We were able to contribute 960,000 over a 6-year window to get the family $4 million tax-free to cover the tax bill upon death. Like, the rate of return on this is significant. Every single year, if the business owner wanted to invest in something alternatively, they needed to earn 11 to 12%. to outpace this investment, which is very, very hard to do, if not close to impossible, with a standard deviation that comes with a lot of these insurance portfolios. And we were, if you guys were listening to Garth's session on standard deviation and means, as accountants, we love standard deviations and means. If we have a standard deviation of anywhere from 1 to 2, basically it's telling you that it's not that volatile and it's not going to move around that much. So that was the professional case. I have only a couple minutes left, so I need to get to the real estate developer. Real estate investors, real estate developers, when they speak to me, they always say, you know what, forget it. I can make a lot more money on my own capital, so I don't want to talk about any type of investments or insurance, and I love these type of clients. So these clients are always fun to work with because they understand that they have this client had a $9 million tax bill upon death, and he understood that he had a problem on how to fund it. So we looked at a leveraged insurance strategy. So the strategy is as follows. You deposit money on a Monday, the money comes back to you on a Friday, you carry the interest rate at 3%. Current interest rate environment is amazing for this. It's a variable interest rate, and you go redeploy your money into your real estate projects. So if you didn't catch that, you deposit the money on a Monday, the money comes back to you on a Friday, you have to carry the money. So there's an interest cost of doing that of about 3% in today's interest rate environment, and you go reinvest in other real estate projects. So meanwhile, while you build an asset inside insurance tax deferred, you get tax deductions on the interest and the net cost of pure insurance, and you go play with your money in your own real estate projects and developments. So real estate developers, investment professionals, they really enjoy these type of strategies. And instead of going through every single number up there on the chart, I have one very clean slide that shows the summary. So this real estate developer has a $9 million tax problem upon death. If we were to use the corporate money to get the $9 million cash payout, it would cost this family business $16 million. That's right. Because of the dividend tax rate, you're looking at a gross up of 45% to get the $9 million payout that this person was going to have upon death. What are some insurance strategies? Strategy number one, we can use the fixed variable approach. It would cost the corporation $4.2 million to get that same $9 million payout. Or we can use a leveraged approach. It'll cost 2.5. The question should be, why wouldn't everybody pick the 2.5 approach? You have to be comfortable with carrying debt. So not everyone loves carrying debt. So some people do. And if you can carry the debt and are comfortable with a variable debt carry, then it could be an amazing strategy for a lot of real estate developers, investors, and people that know how to make double-digit returns with their own money, but still want to leave a tax-efficient legacy behind. So that's what I'm going to leave you with. My contact information is up there. I had a tremendous amount of fun. I hope everyone was able to glean something from this. Had to make it quick. Thank you for tuning in. And I think I will see everyone on the live stage or in the networking sessions later on. Thank you.
Hi, Tony. Can you hear me okay?
I can, yep.
Hi, this is Alex. I just wanted to come on and say thanks again for presenting today. Mark is just on the main stage, so he couldn't come in to thank you himself. But I just want to say thanks for speaking at today's event. I'm just, before you go, I just had a quick question. What's the best way for people to reach you if they want to get in touch? Through LinkedIn or email or?
Yeah, LinkedIn or email.
Okay, great. Perfect. I'll throw those up in the chat for you. Thanks again, Tony. Great to have you.
Thank you.